Hello and welcome to my morning note. US earnings season is on us once again, and it's a particularly interesting one this year. Nobody's expecting anything particularly exciting from top line growth, that's growth in the economy, which means that all the emphasis is on margins, which to some people look as though they are cyclically high. But there are also interesting arguments that perhaps US companies can find ways to increase their profitability still further from where they are now. Luckily, we have with us today to discuss this in town for Goldman Sachs' annual Global Strategy Conference, their Chief US Equity Strategist, David Kostin. David, thanks very much for finding time to be with us today.
Great to see you.
Let's start out by taking a look at where the consensus expectations are. And you can see that third quarter we did actually have a year-on-year decline in S&P 500 earnings, but the consensus seems to be that things are going to get better from here on in. Does that seem accurate to you?
It does. In fact, our forecast has the similar trajectory. You'll see in the third quarter that was the first time since 2009 that you had year-over-year decline in earnings. And the expectation that my forecast has is that earnings will be slowly rising over the course of the year. I think a way to think about this is that in the first quarter of 2013, right now, the U.S. economy GDP growth is about 1.5%.
Yeah.
And by the first quarter of 2014, 12 months from now, the growth of the economy will be running at about 3%. And this is a transition year in 2013. And I believe you'll see the earnings rise slowly from about $100 per share of earnings last year to about $107 this year.
Okay, now let's take a look at the long run effect that earnings have on the markets. The last few numbers here are obviously projections. We don't actually know what earnings per share is going to be in 2015 just yet. So last year was largely a story about multiples widening, but you can see earnings driving growth from here on out.
Over time, earnings basically drive stocks, and the margin is a key variable on why this earnings growth has recovered so much.
Okay, so let's get to margins. This is a fascinating chart that you put together. If we look at that red line, which is the margin for the S&P 500 as a whole, that seems to bear out the notion to me that things are cyclical. This is looking high. It looks as though we're ready to snap back a bit. So what's wrong with that analysis?
Well, I think there's a couple of things. The first is you'll note that the earnings or margins tend to go lower during recessions. And so in our forecast period from now through actually 2015, 2016, we do not have a recession built into our economic forecast by my colleague John Authers. And so if you look at the trajectory of the margins, they're basically stable. This is across the S&P 500. I think the key driver you can see right here very clearly is that technology stocks have been the overwhelming driver for why the overall market has had.
Which is basically many of them are basically quasi monopolies at this point. They have a lot of pricing power and they're enjoying exerting that pricing power.
Well, it's interesting. Every company is looking at the opportunity set to grow its own margins. And the opportunity really comes from using technology in their own businesses as a way to more efficiently produce it. Because the top line growth is modest and the economy is only growing at a modest pace.
But surely this tech margin that we're seeing here still doesn't look sustainable, does it? I mean, one way or another, people are going to find ways to get a share of quite such nice profitability as that.
So the concern is there's a relatively few number of companies in technology, led by Apple, for example, where the margins have been extremely high, and they contribute a considerable amount of the margins for tech, and tech, as you see here, is contributing a large amount of the margins for the overall broad S&P 500. But there's a couple other reasons that companies are able to withstand some pressures, and that is that there's a lot of slack in the labor market. It's not a lot of labor inflation. There's the shale energy has allowed companies to keep their input costs under control. So there's reasons that margins, and they've been flat now for 8 consecutive quarters. All of 2011, all of 2012, for the S&P 500, margins are hovering just under 9%. And my forecast is they will stay below 9%, around that level, for the next 2 years. Neither go up nor go down. You don't have mean reversion because you don't have a recession. And they don't necessarily go higher because, as you see, that there's some evidence that would suggest that margins are peaking in many industries.
Okay, David, thank you very much indeed. I think one final comment to make about this, it's obviously an extremely finely poised position in the profit cycle. This is an earnings season when it's very important indeed to look at exactly what executives are saying, particularly with regard to how they feel about their profitability.